Traders, today we're going to dive into trading CME Group interest rate products, a beginner's guide. Agha Mirza, global head of rates and OTC products at CME Group, joins us. He'll demystify trading interest rate products. These potent financial tools react to interest rate fluctuations with futures to options contracts tied to diverse benchmarks. The 10-year Treasury Futures Contract. Ever hear of it? Well, it's the prime interest rate product allowing traders to speculate future interest rate movements and manage risk. You can go long or short to profit from rate shifts. On deck today, some macro environment insights, short-term risk management tools, Fed policy uncertainty, Fed watch tools, exposure across the yield curve, and a synopsis of the micro Treasury yield futures. What's up, traders? Anthony Crudele here, and today's podcast is brought to you by CME Group. Whatever the obstacles, CME Group provides the tools that global market participants need to manage risk and capture opportunities. With 24-hour access to futures, options, cash, and OTC products across all major asset classes, you can drive your trading strategy forward with confidence and precision. CME Group, where risk meets opportunity. Agha, welcome back to the show, my friend.
Hi, Anthony. Thank you for having me again on your show. It's always great to be here.
It's great to have you back. We're going to focus today on interest rates. Obviously, that's your forte, what you do at CME Group. I want to start off with the macro environment, because in this environment, I talk about this nonstop really on social media and my Discord, anywhere where I'm talking to traders. If you're not watching interest rates right now, you're missing the whole game, because the interest rates at this point are the focus of pretty much all markets. And you could say that really at almost any given time. But right now, traders are hyper focused on interest rates. What are your thoughts on this current macro environment we're seeing?
Anthony, as you said, and you're absolutely right, that the market participants, traders are very focused on interest rate markets. We are seeing unprecedented moves, both in terms of volatility and in terms of magnitude of moves over time. If you go back, months and last few years. So from our perspective and for our clients, the risk management and hedging needs are elevated, and interest rate and treasury futures markets are on the move. You mentioned macros. Certainly, the broader macro environment is the number one driver of what is happening in the interest rate markets. Inflation remains elevated, or while it has come down from 6% or so, it's still 4%, double the Federal Reserve's 2% target. Understandable, therefore, that there are monetary policy related interest rate changes going on. The federal deficit, the United States government deficit, is running at a record $1.5 trillion per year. And if you look at the various forecasts, the federal deficit is forecasted to persist and rise over the next decade, reaching as much as 2.7 trillion as per various forecasts in 10 years' time. What this has done is it has increased the amount of borrowing by the US Treasury. Most recently, there is now 25 trillion of marketable debt the market has to risk manage. And then I just listed 2 or 3 distinct drivers. And to add one more, the Federal Reserve is reducing its balance sheet. And that's something that they need to do to try and reduce the inflationary pressures. In the last 1 year, the Federal Reserve balance sheet has come down from $9 trillion to now $8 trillion and more to go. I would be happy to dive deeper into any of those elements, but suffice it to say that there is a great amount of uncertainty. The good news for our market participants is that CME futures markets remain very robust and highly liquid. And this is creating opportunities for institutions and individual traders alike to trade the market.
No, absolutely. And let's dive into that a little bit too, Aga. I want to keep this not to our normal high level. A lot of times you and I will go very high level what's happening. And today I want to really focus on really a beginner's guide for people to get involved in interest rates. Because, like we started off today's conversation, there's probably no more important time that in my 20 plus years as a trader to be watching interest rates than right now. I mean, I guess you could maybe say that over the last 10 years, there's not been a more important time. But nonetheless, as interest rates are going higher, they are really just having a massive impact across every asset class. Let's talk about some of those short term risk management tools that CME Group provides for all levels of traders to be able to hedge risk and speculate on price.
Here, Anthony, the short-term rates are driven largely by where the Federal Reserve sets its interest rate policy target, which is based on the Fed fund rate. That target, if you mentioned the 20-year number, is at the highest level that it has been in 20 years. Currently, the Federal Reserve is targeting 5.25 to 5.5% for Fed fund rate. What that has done is it's lifted up all the short-term interest rates. CME has a number of futures contracts that are very relevant and helpful for management of the risks that arise from changes in short-term rates. We have SOFR futures that you and I on this show have discussed previously. SOFR is really our anchor benchmark short-term interest rate product. There we are seeing a record amount of trading and risk transfer, over 5 million contracts trading in SOFR futures and options. That, as you may remember, SOFR futures and options replaced an older contract, dollar futures and options. And this year, SOFR is trading 30% higher than the entire than any year in the entire 4-decade history of Eurodollars. So certainly lots of liquidity and active trading that is taking place as the Federal Reserve has continued to lift policy rate, which again drive the other rates such as SOFR. Talking of policy rates, Fed fund futures are trading very actively this year at record levels, almost 500,000 contracts in terms of average daily volume. But before we go, any further or deeper into Fed fund futures, which is again significant, very interesting topics actual for the listeners, let me bring up Treasury futures. Treasury futures are our newest contract that we have just launched back on October 2nd, Monday last week. This contract is intended to help hedge the yield risk for 13 weeks, or what is also commonly called 3-month Treasury bill contract. The Treasury bills this year, along with the deficit and the rising federal debt, are increasing in their quantity that they're available in the market. Just in 2023, the Treasury is estimated to issue almost 2 trillion of Treasury bills. So lots of Treasury bills to hedge. And I'm sure that your listeners read about and hear about a number of firms investing actively in Treasury bills. Those are really some of the reasons why our market participants, clients have been very interested in CME creating a contract that helps to bring all the benefits of futures, the automatic margin offsets, the commodity spreads, and really the standardization and simplicity of futures. But as I mentioned, we launched Treasury bill futures last week. A great and successful launch for us. Numerous clients already involved just in 1 week, and we have traded 6,500 contracts. Lastly, what I will say is that let's tie the relevance of Treasury bill futures with SOFR futures. SOFR, as we just discussed, is the benchmark contract, which sees over 5 million contracts or daily volume at CME. So the idea would be that as there is greater Treasury bill issuance, the spread between Treasury bill and SOFR futures that is based on historical analysis or would be stable is now on the move. Historical analysis shows that just in 2042 and 2023, the typically stable spread of around a few basis points widened to as much as over 40 basis points. So great opportunity to trade Treasury bill futures either outright or as a spread. So for futures, and once again, CME systems such as our electronic trading system. Whereas they provide seamless spread trading, the efficient inter-commodity spread that is already defined in our systems.
Yeah, no, thank you for explaining a lot of that for us. And I know for a lot of traders out there, this is new, but what's not new is something we've talked a little bit about. We talked about how important of a time this is for interest rates. I mean, let's just face it, when you go back in time here, you had the Fed easing, right? QE, everybody remembers it. It really felt as though we almost kind of always knew that the Fed was going to keep cutting rates. I mean, obviously, we were watching the CME Fed Watch tool, which I know we'll talk about, and it seemed just really consistent. And it felt as though we just knew rates were just going to keep going down. They were going to take them all the way to the bottom if they could, right? Or even negative. Now it's anyone's guess. I mean, we've been seeing rates go higher over the last, what is it, about a year now, maybe a little bit longer. Time goes by so fast. But we're at this kind of critical time right now, Aga, because I can go back and say 3-4 months ago when I was looking at the Fed Watch tool, totally different what was anticipated to be where we are right now here in October. And it seems like every month it's changing. And I've talked a lot about how important the Fed Watch tool is, which is tied to those Fed fund futures, to see what the market is looking for the future of rates because of everything we discussed. This macro environment, this uncertainty is really difficult to play as a trader, even beyond a day, and even sometimes a day. A lot of times a day can even be very difficult. But the interest rates, where they're going, is without question the most important part of my trading. And I know for most traders out there, they're all focusing on interest rates. Talk to us a little bit about the Fed Watch tool.
Anthony, we are very excited about the value that the Fed Watch tool has delivered to our clients and to our marketplace. It's a tool that provides a gauge of the chance of upward and downward rate movements. As you just said, that rate movements are really the key topic in the marketplace today that are driving not only the bond markets and our short-term interest rate futures markets, but really also impacted other asset classes. In fact, it would be interesting for your listeners to have a little bit of background and history of how the Fed Watch tool came about. The traders in the interest rate world have a long history of using their own calculations, spreadsheets, paper, pencil, whatever you have it, over the last 3 decades to help translate the prices from the Fed fund futures market into probabilities of interest rate moves by the Fed. Probabilities are really what the mind can process a little better than just looking at the prices of a futures contract. So what we did was, a number of years ago, we took a fairly defined, sophisticated version of the methodology to convert these futures prices and created a tool that is publicly and openly easily available to all. So what the Fed Watch tool has done, it has really leveled the playing field. Institutions, official sector, individual clients, retail, all participants alike can now access the same information that historically institutional and sophisticated participants were able to figure out on the market. And as what you and I know today, the Fed fund futures is a multi-trillion-dollar market, over $8 trillion in interest. So clearly, the collective information priced into Fed fund futures is the market's view of what the Fed is likely to do. So the Fed Watch tool is taking all that information and translating it in probabilities. And this is not just my view. If you look at the widespread usage of Fed Watch tool today, it is quoted in thousands of media articles where it gets time, let's say a number of months or so, and visited on our website by millions. So it's a very useful tool. And if I may, connect that, all of that with the significance of what you just mentioned, your remarks earlier, you said, in 20 years, we really haven't seen such more benefit. Today, the rates are at the highest level that they have been in the last 20 years. And all of that implying Federal Reserve policy target rate was achieved really just a year and a half. Fed increased rates 11 times since March of 2022. And while some may think that the bulk of the Fed interest rate action is done, the Fed Watch 2 is actually showing further potential action by the Fed. And what is priced in for the next year will be quite a change for what we have seen so far. Fed Watch 2 is pricing a few rate cuts, of relatively smaller magnitude, 25 basis point each. But in 2024, there is rate cuts priced in, a significant change of what we saw in 2022 and 2023 with rate hikes. And really, whether these rate cuts are realized, whether they're delivered, only time will tell, because we have a dynamics where growth and inflation are slowing down from their very strong level, but growth is still resilient. And inflation, even today, stands at almost twice Fed's targeted 11%. So which way to go is a great opportunity for the participants who express their views by looking at what's priced in. If they think that maybe there's a chance that the Fed may raise, and that chance is higher than the probability of rate hike that may be priced in for the November. You understand, may want to express that view by selling the year contracts. And when it comes to easing scenarios, those participants who may think that the chance of Federal Reserve cutting rates next year are higher than what is priced in, as shown by the Fed Watch 2, then it would be an opportunity for them to buy the contract.
Yeah, a lot to take in from that, but my first thoughts are how much is in there in the Fed Fund Futures open interest? It's incredible. You said 8 trillion.
In contract terms, it's about 1.7, 1.8 million contracts. Each contract represents about $5 million notional. So yes, in dollar notional terms, the Fed Fund Futures market is trillion.
It's crazy to think, right? And to talk to all of the newer traders out there, think about how great this Fed Watch tool is, because I go back to prior the Fed Watch tool. Like you said, I wasn't sophisticated enough to know exactly what to look at down the road based upon what was happening with the Fed Watch futures to determine what the Fed may do with interest rates. And now at this critical moment where we talked about the heightened amount of uncertainty, let's just talk about this a little bit, where we say, you said that the Fed target of inflation is 2%. It's nearly double, right? Right now at 4%. And then you have Fed Fund Futures, you have people in the marketplace. This isn't CME Group saying this. This is people in the marketplace going out there saying that we're going to get cuts. And this is where you have this debate for higher for longer. And as a trader, we need to see what the market is pricing in. And this Fed Watch tool, to me, I don't know what I would have done without it in the last couple of years. And I will say this, from every top macro person I have on this show to the retail trader out there who just began trading futures, it's a tool that you can use.
Indeed. As you just said, for any market, the basics of trading is to formulate one's own view and to assess what may be priced in. And obviously, the opportunity to trade arises if one's view is different than what's priced in. And in this case, the Fed Watch tool makes it very easy for the participant to know what is priced in. And as you talked about, cut, it's a very interesting dynamic. There is a small chance of actually a rate increase priced in end of this year. And then as we go into the next year, then the pricing turns in rate cuts. And it will be a very interesting dynamic to observe whether the Fed is able to deliver what is priced in, because, once again, inflation is still kind of 4% or just under 4%, depending on where you look at, clearly above the Fed's stated target of 2%.
Yeah. And let's take it to the next level. When I first began trading, it was really only the 10-year, the 5-year, the 30-year, obviously there was other products as well, euro dollar. And those products were intimidating, I think, for the introduction trader into interest rates, right? It's not the easiest to know that when a bond market's going down, it means interest rates are going up, and then you don't know what the real rate is. And a lot of times as traders, or investors will look at the yield and say, oh, the yield, I just wish I could trade that, right, Aga? I just wish I could go and trade that yield. And now CME Group has made that a reality with the micro treasuries. And it's also priced really fair. I would say fair, what I mean by that is it's not as expensive as it would be to be able to go and trade, the 10-year or the 30-year. And what I look at every day, looked at it today, what is the 2-year? What is the 10-year? What is the 30-year doing? Because I want to see what interest rates are doing and how they may have an impact on equities. A lot of times it's if the yields are down with these micro treasuries, you're just trading the yield. So I could see that the actual yield is, and then if it's going down, I could trade that. I could trade it long, I could trade it short, and I could just watch it if I didn't want to trade it and how it would impact equity markets or any markets that you're trading. Talk to these traders out there about the micro treasury futures complex.
Thanks, Anthony. As we have done on your show previously, I to share information about our micro treasury futures exactly because of what you said, because they are designed so simply and in such a user-friendly way. Treasury markets, as we all know, are very large. Now the marketable debt is about $25 trillion. It's the primary mechanism through which the United States government borrows money. But having said that, traditionally, as you said, Anthony, prior years, the benchmark treasury instruments were traded in price terms, while the most quotes, widely available quotes, whether it's in media or on CNBC, financial news, tend to be in real terms. So we are very excited about our micro treasury futures contract. They are designed simply. You can trade the contract in 2-year, 5-year, 10-year, 30 terms, pretty much exactly how the yields are quoted in various sources. But let's take an example. If the 2-year micro contract is trading at 5.0%, you think that yields are going higher, then you buy this contract. Not only that, the code is simple, but the instrument size is also simple and small. It requires a much lower buy. And the contract size is $10 per basis point a year, or really $1 per smallest stick of wheel. So easy to trade, lower buy-in, and also because of the $1 per smallest stick available, easier to track your P&L. And another nice and unique feature about the micro contracts is that as often our market participants, our clients are interested in trading the so-called yield curve, which are relative movements of, let's say, 10 versus the 2-year, 5 versus the 30-year. We make these curve trading really easy through Globex, our electronic platform system listed into commodity spreads. So you can trade the micros outright or as a spread each other. While we're on this topic and the significance of the treasury market and price changes in it, let me just share with you that this ties back with what you said, Anthony, previously, that this is really a time of historic proportion in the treasury markets. If you look at the years, the 2-year micros the years have increased almost 5 percentage points in just 3 years from the lows that were seen in 2020. The 10 years have increased from a weaker 50 basis points to now 480. That is about 4.3% increase. The 30-year micro yields have increased almost 4%. And what does this mean as compared to other markets that our participants may be more used to, equities and commodities? The 10-year change corresponds to the percentage points which are observed in our standard. It's the Ultra 10. Ultra 10 Treasury Futures is the bigger institutional Treasury Futures contract that has existed for a number of years, that has now 2 million contracts in open interest, that has a decline by almost 50 percentage points in the same 20 period to now. And Very remarkably, the ultra bond Treasury Futures Contract, which is a price-based long bond contract, has declined 120 percentage points. And thinking in terms of price and percentages, which is how other asset classes trade, type of moves we are seeing the last couple of years, the treasury markets are really comparable or bigger than some of the biggest we have seen in recent years in any asset class.
Absolutely. I mean, just to kind of wrap up today's conversation, I know that we're out there trying to give the retail trader, the newer trader, or even an advanced trader a guide into the interest rates markets. It's a complex environment right now. There's uncertainty across the board. We talk about how the Fed is raising rates, but we're not sure for how much higher or how much longer. We talk about the Fed Watch tool to be able to give you an inside look at what the market is pricing in the future, not what maybe some of the pundits are saying, whether it's on social media or on the traditional media. And then we talked about this micro treasury. To me, that is the place where new traders can go and participate in the interest rate markets because it's comprehensible. You can go in, you can see it. If you think that the Fed Watch tool is pricing in rate cuts and you want to be a part of that, you can go in there and you can short the 10-year, the 30-year, or the 2-year, or whatever it is that you decide that you'd want to do it. You can do the 210 spread. You hear everybody talk about that. When we get near recessions, everyone talks about, the 210 inversion and, steepening. You can trade all of that there. And one of my favorite things about what you did with that complex, Aga, is you didn't make the tick values and the basis point values all different ones for different markets. They're all the same. So they're all $1 a tick. They're all $10 per handle, which would be, what was it? 10 basis points. And so I think that is so important because as a new trader, you can come in and you can compete with what the bigger guys have been doing for a lot of years. And so, Aga, I don't know if there's anything else left for you today, maybe some things that maybe you want to mention for traders that are interested in interest rates, maybe some things that they should, or some things that maybe you'd like to mention before we go today.
Anthony, I just want to thank you. And I just want to say again that this is a historic time in interest rate markets. If you ever considered getting involved in interest rates, this is the time and opportunity. Contracts are clearly on the move. We have a number of tools, Fed Watch tool, Treasury Watch tool, and the products that we discussed, micro year trend futures, as well as our new Treasury Futures Contracts, our SOFR futures, and the Fed Fund futures that will power the Fed Watch tool. Information on all of these is available on our website. Highly recommend you check those out.
Yeah, everybody go to CMEGroup.com and also follow CME Group on Twitter. Aga, my friend, it's always a pleasure. You're one of the smartest people that I know, and I always love picking your brain on the interest rate markets at CME Group. Thank you so much.
Thank you, Anthony. Pleasure.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a 5-star review on iTunes. Never miss an episode. Go to anthonycrudele.com and get on our email list for show notifications and for free content that is exclusively for subscribers. Also on anthonycrudele.com, you will find tons of videos and education on trading futures, options, and crypto. Past performance is not indicative of future results. Opinions expressed are solely my own and my guests, and they do not express the views or opinions of my sponsors. Futures Radio Show is produced by Crudele Productions.